All right, we're at the 12:02 mark. I know we started just a little bit late, but I think we're going to go ahead and get started. Welcome, everyone, to the HFMA Colorado chapter webinar series. We want to take a moment first to recognize our annual business partners who not only provide financial support to our chapter, but they also share their knowledge and expertise through providing speakers and presentations and webinars like these. Their support allows us to operate our chapter and bring our members the quality education and resources that you have come to know and love. We hope you will all take a look at these sponsors first when your organization needs services or support. For today's webinar, we're going to use the Q&A box located in the bottom right of your screen. We will address all the questions at the end of our presentation today. A link to download the presentation is going to be provided in, well, actually, we have an updated one. So I will send out an updated presentation to everyone at the conclusion of this webinar. Today's webinar, Patient Lending, What You Should Know About Patient Loan Programs, is being provided by our 2020 virtual sponsor, CommerceHealthcare. Today's speakers are Taylor St. Eve, Hannah Simons, and Kate Duker. Taylor joined Commerce Bank in June 2013 in the management trainee program. He has extensive background in finance, underwriting, product development, relationship building, and revenue cycle management. Since 2014, Taylor has worked on the patient financing team in various roles, most recently on the national sales team. He is a graduate of Southern Methodist University, where he played collegiate tennis while earning his bachelor's in finance and journalism. Taylor is currently working on his executive MBA in St. Louis and is an active member of Healthcare Finance Management Association and AHAM, the American Association of Healthcare Administrative Management. Hannah Simons joined, I hope I'm saying that right. I didn't ask. Is it Simons or Simmons?
Oh, it's good. Simons. You're correct. Thank you.
Hannah joined Commerce Bank in 2018 as an account executive in the Merchant Services Department at Commerce Bank. Since joining the organization, Hannah has worked with clients in many industries, including healthcare, to reduce cost in card acceptance, create back office efficiencies, and help organizations increase patient customer satisfaction. Prior to Commerce, Hannah honed her relationship building and merchant industry knowledge as a regional director of business development for an ISO based in Kansas City, which then relocated her to Denver. She now maintains a strong professional relationships in the Colorado area and throughout the western region of the United States. Last but certainly not least is Kate, and she is the Healthcare Relationship Manager and Assistant Vice President. She's been with CommerceHealthcare for 7 years. I hope everyone will join me in welcoming our speakers.
Well, thank you for that warm welcome, Jessica, and a big thank you to Colorado HFMA for this opportunity today. We are excited to present to you all about solving challenges in patient collections, and part of that will be focused on those patient loan programs. But if you guys are anything like us, well, first off, Happy New Year. We wish you the best in 2021, but if you guys are like us, we're looking at the challenges that were presented in 2020. We'll try not to say the dirty word pandemic too much today. But there were a lot of lessons to be learned last year, and we are looking at those challenges last year, and some of them are continuing so far this year, but we know there's a lot of room for change and improvement that's being driven by that. So we appreciate you guys joining us for this webinar today. So like I said, it'll be focused on solving challenges in patient collections. And our goal today is to help you, learn about the trends in the industry and the technology that's out there to help you improve your patient financial experience, as well as offer potential options for improving your team's financial experience as your teams process these patient, throughout their patient financial journey. So we'll do that in two ways. We're going to focus on patient payment strategies and how that's moving to digital platforms, as well as those patient loan programs. So, and with that, we'll dive in. So we'll skip this slide because Jessica already gave us a great intro. Our contact information is at the end of this presentation as well. So feel free to reach out to any of us, and please don't hesitate to ask any questions as they may arise during the presentation. We're happy to answer anything you guys may have for us. So a little bit about, who is Commerce Healthcare and who is Commerce Bank. Commerce Healthcare is a division of Commerce Bank, if you've heard the name Commerce Bank before. Commerce Bank information is on the right side of this slide. Commerce Healthcare is focused on the left. The bank itself, with it being 2021, this information is a little dated. We've been in business for 155 years. We're a publicly traded company, but we are in our 6th generation of Kemper family management. So we're a super regional bank that's headquartered in the Midwest, but we, Commerce Healthcare is national. You can see that we have clients all over the country, with over 500 health systems using at least one of our services. We're in 47 states, and we have over 805 million outstanding patient loans today. So the bank itself, you can see we're one of the top rated banks according to Moody's credit metrics. And we like to say we punch outside of our weight class. We're a super regional bank, but we're also able to offer services that larger banks provide, but we like to do it at more of a community bank model where we're very high touch, we're very relationship focused, and we've enjoyed getting to know some of you over the years, and we are excited to get to know more of you, and hopefully before long we'll be back in person instead of seeing each other virtually. So Commerce Healthcare is that division that's solely dedicated to healthcare payments and services, and we benefit from that full commercial bank. So the commercial bank offers credit, the full treasury suite, merchant services and payment services, as well as institutional trust if somebody were to need help with trust assets. But years ago, we took a look at our portfolio and saw that we had a concentration of healthcare clients. And so we decided to go all in on healthcare, and we began devoting significant resources to healthcare. So we developed new products specifically for revenue cycle challenges, as well as taking existing products that other commercial clients used to tailor them specifically to healthcare teams. So we have a dedicated team to solve those healthcare challenges, and we'll dive into some of those products in a bit. But first, just because it's top of mind for a lot of people, with the second round of PPP rolling out, I did want to share a little bit about our involvement with, helping provide relief for clients around the pandemic. So, historically, we've had a team of about 5 people in our SBA group. We flexed that this past year to help process these applications for PPP loans, to where at one point we had roughly 700 employees devoting at least part of every day and their daily duties involved PPP loan processing or servicing or booking, to help provide that help for our clients that needed it in quite a time of need. So just wanted to share some of these highlights because we're very proud of how we were able to help our clients when they were struggling. So like I mentioned, so Commerce Healthcare, we've devoted a lot of resources to developing services to help your teams. You can see on this slide, pretty much anywhere where there's an exchange of funds, we have a product or service that we have worked to develop to either create an efficiency, reduce cost for you, or to potentially create a new revenue stream for healthcare teams and healthcare organizations. So you can see that with this, our goal is to become the preeminent bank for healthcare providers, and we're going to touch on a couple of these opportunities, these services that we provide later on with Taylor and Hannah. So a big differentiator for Commerce, not only are we devoting resources to develop that technology, but additionally, we're devoting resources to bring in healthcare talent to help drive this team. So it's not just bankers who we're turning into healthcare specialists. Our team is managed by healthcare professionals who have specialized in healthcare and been on the other side, your side of this, their entire career, and we've brought them into the bank so that we make sure we're tailoring these products specifically to your needs. because we know, revenue cycle is an animal of its own, and there's a lot to know about it. And so we've brought in those specialists to guide us, and you'll see that throughout this presentation. So with that, I'll hand it over to Taylor to kick us off with a little bit of trivia.
Yeah, thank you, Kate and Jessica, for the introduction, and thanks to everyone today for joining. I'll just second what Kate was saying. Thank you to HFMA for allowing us to be here today. I want to thank all the providers out there that have joined. My heart and prayers go out to you to keep everyone safe and healthy every day, to do what you do. And what Commerce does to help healthcare more affordable is important, but obviously what you do is way more important, and thank you. And what drives me to do my job is to help providers do what they do well. So just to jump in, we'll get into some of the nuts and bolts here in just a few minutes, but I wanted to start off with a little trivia. And the first question that we have on deck is, combined premium contributions and deductibles have grown to reach what percentage of median household income? Is it 11, 30, 23, or 48%? We'll give it just a couple of seconds for folks to engage here as much as we can engage through virtual experience today. Okay, let's go to the answer and see how everybody did. Answer is 11.5%. Most folks were at 23%, but it's very close to that. So we'll move on to the next question here. What percentage of workers are subjected to a $2,000 or higher deductible? That's today in this world and environment. Is it A, 8%, 14%, 28%, or 37%? This is a toss up here. All right. Let's go to the answer is C, 28%. So we're definitely there, 37%, most majority. So we split the difference there. We'll go on to the last question. Prior to the pandemic, what percentage of Americans were just covering basic living expenses? Is it 3, 12, 23, or 30? All right. Let's see here. We have answer is D, 30%. There we go. Everyone got a passing grade. We'll end on that one. Thank you guys for participating. Want to quickly just highlight our agenda for the day. We're going to talk about the rise of patient payers and consumerism today. We hear that word, the buzzword consumerism, quite a bit. What does that mean? And what is CommerceHealthcare doing about it, and to help providers and patients? Best approach for meeting your patients at their point of need. What does that look like? And then where and how is the patient financing offered? Increasing the focus of your digital online strategy. More and more providers are going online, and then measuring the cost and the value of providing your digital strategy patient financing program. So increasing focus on consumerism. I've been in banking now for almost a decade, and a lot has changed since then. It doesn't sound like a long time, but a lot has changed. We all know, working in healthcare, changes happen every single day. And as new administration comes in, things are going to continue to change. And I was underwriting hospitals. We would look at payer mix, and the patient was usually a small percentage of that net patient revenue, maybe 2, 3, 5%. Now, when I look at audits of facilities and providers, hospital systems, and speak with providers, it's almost as high as 15. Sometimes we'll see 20%. So that out-of-pocket responsibility is definitely on the rise. And all the research today points to that there is no slowing down of this. I saw an article recently published, I think yesterday, in Recourse Healthcare, that fewer than 40% of Americans could afford a $1,000 unexpected medical bill. So what are we all doing about this to be able to help patients and give providers the tools to be able to focus on what they do well clinically? So the easiest way to keep premiums low is jack the deductibles. And this must be done because healthcare expenditures keep rising. And we all know that with price transparency is new this year, simplification of statements to help patients understand their bills. All this is so important. And there's a correlation between that satisfaction with patients and their payments. Satisfied patients are more likely to pay. And so a few of these other items is patient requesting, they want more options, and the staff seeking more options for the patients. This slide here talks a little bit about consumers and how they are paying in terms of the hierarchy of payments. All consumers prioritize in this way. Mortgage, auto, utility, banks. When banks are unsecured, we're in the middle of that priority ranking. And unfortunately, medical providers, they're on the bottom of that stack. I might even put competitors down here on the bottom, but a lot of what we talk about is transitioning that obligation from your healthcare debt to bank debt. Patients want to take it more seriously and they want to pay their bill. And by offering a true bank loan program, the benefit to the patient is by allowing them to be familiar with paying a bank. Most people today pay banks. Consumers want to pay their banks. They're already doing business with their banks, mortgages, auto loans, deposit accounts. Make it convenient, make it easy for them. And they're more likely to pay a bank than anyone else out there because they're used to doing that. But it's not that bad. Patients want to have a loan to the provider. And what are they seeking? It gives them their dignity to know that they have paid off their doctor in their hospital, someone that they might know and is a friend of theirs, their physician. They can make payments privately to a bank, and most patients are used to paying bank and someone that they work already with. What patients are demanding is their equal access to credit, and they want to make it affordable for themselves. The providers want to make it affordable. So give them all the ability to make it affordable. And it's fine, if providers want to give 12 months for $1,000 bill, but 12 months for a $10,000 bill is just unmanageable. And so looking at what is the cost value of extending your payment plans longer than a certain term. So give them a plan that gives them longer terms and lower payments for the higher dollar balances. So these four are critical, and we'll digest this a little bit more as we go into the slides, but I'm going to hand it off now to Hannah.
Thanks, Taylor. So I'd like to take the next few slides to dive into some of the trends that we here at Commerce are finding in terms of what patients are now requiring of their providers and how providers are effectively answering to those needs. As Taylor mentioned just a moment ago, we know that patients want more options, and they want those options immediately. We also know that patients are making healthcare decisions based on their overall experience, which includes the financial journey that they have with their provider. In our research, we found that providers see up to a 90% boost in payments when offering patient discount at the point of service. We know that 92% of patients would return to a healthcare facility that offers a loan program. 64% of patients also want flexible payments, and providers see 54% more electronic payments when patients have the option to pay by phone or by text. So bottom line, we know that payment adoption is dependent on the ease of making that payment and the payment options available to them at the time of making that payment. So let's review just a typical payment hierarchy or financial journey with a provider. I'm going to pick on Taylor just a little bit, and he's going to be my patient for my example here. Let's pretend that Taylor found out that he needs a medical procedure. We know upfront the provider now provides those estimates on what he could expect to pay for that particular procedure, and if possible, offer payment options, including patient financing based on that total that's due. At that point, we know that the provider then collects payment in full any way possible. So offering check payment, card payment, and new hot topic is instant payment apps like your Apple Pays and your PayPal. If possible, a prompt pay discount is then offered to Taylor to try to encourage that full payment. At that point, if Taylor's unable to pay in full, we know that the provider then establishes a short-term payment plan. Typically, this short-term payment plan is established and serviced by the provider, but there are solutions out there now that allows the patient to really manage that short-term payment plan. As we all know, times are tough, and for Taylor, maybe it's especially tough, and he's not able to make the short-term payments that are required on that short-term payment plan. So then he's offered patient financing, ideally at a 0% interest, but we'll talk about the different benefits to the different patient financing options out there. While short-term payment plans certainly are great, we do know that spreading those payments over a longer period of time increases that likelihood that Taylor can then make that payment. Ultimately, if Taylor, let's say he disappears to Mexico, unable to get a hold of him, or just is unable to make that payment in full, the provider then writes off that account to bad debt, which we all are trying to avoid. So what can you do as a provider? What are the trends in the market? How are other providers effectively managing this patient financial journey through the process? We live in a digital world, and the new best practice is creating a digital patient experience. But there's a lot of things that play into that. We know it's no longer just collecting payments online, getting your bill and then going online and making that payment. What a digital patient experience looks like for a provider who is effectively handling that is branded digital communications. So reaching the patient through email and then also through text messaging. We also know that the digital experience should include that payment as well. So having the ability to text to pay is a great example of that, or the ability to for the patient to indicate that they're interested in patient financing without having to pick up the phone. All of the digital marketing and digital experience should feel like they are getting all of their options. The provider is actually promoting the different payment options that are available to that patient to try to encourage that payment. We know that significantly increases that payment adoption for the patient, or for the provider rather. This also can be used to promote any other events, donations, or new technology available to the patient. A couple additional tools that we are finding in the market is one-click payments. You're wanting that speedy checkout to encourage payment when the patient is ready to make that payment. And then it's a consumer-driven checkout experience. So think retail-like environment where the patient can actually put multiple bills into one payment, or multiple dependents, for example, into one payment plan, so that they can do that, take care of all payments required in one step, essentially. We know that this experience needs to feel easy, and we know it needs to feel positive for the patient for this to be effective. While we love our patients, and we certainly want to make sure that they get the best care and what they're looking for, this has to make sense for the provider as well. So there are solutions out there that keep the provider in mind. We know that there are solutions that can collect all forms of payment. So not just the patient, though we are concentrating on the patient today. There's also non-patient payments, other billed services and donations that we know our providers are handling on a regular basis, and looking for a solution that can handle all of those payments is key. A solution should also handle cash reconciliation and manage your bag and deposit management. And it should feel like a retail-like experience for the provider as well. You know, if a patient's on the phone or is in front of an employee of the provider, that provider should be able to also select multiple bills or multiple dependents and create a payment plan on the spot. There are also solutions that are configurable. It should be based on workflow and permission-based users so that the provider or the employee can make decisions in real time. And the solution should fit in no matter where the patient is in their payment financial journey. So pre-service, post-service, and then also at the point of service. So ultimately, while it needs to work for the provider, it needs to work for the patient. It also needs to be easy, and it needs to be automated. Truly automating your accounts receivable is the way these solutions are moving forward. Essentially, it should enhance any investments you guys have already made into your EMR system or any other system on that reconciliation side. At this point, I'm going to turn this back over to Taylor so he can dive more deeply into that patient financial experience.
Thank you, Hannah. Appreciate it. And talking a little bit about some of our integration with HealthPay 24 there. And So when you look at patient financing and we talk about it, patient financing is nothing new in the industry. People are just doing it a little bit differently, more efficient. From a bank, we're getting consumer payments all day long from a lot of consumers out there. So we understand how people are paying and how they want to pay. And so we have addressed this over our couple decades long of working on this financing program to tailor it to something, what we find that providers are needing and they're useful for patients today. So we'll break it down. Patient financing really kind of fits into two buckets. We have the recourse side and the non-recourse side. And what that means is when you talk about recourse financing, the recourse financing relies on the strength and the credit of the hospital system, health system, any provider that you're talking with. And then on the non-recourse side, you're more crediting for your patients. Now, just a plug, Commerce does offer both of these solutions. So we have a lot of analytics and data to be able to talk about this. But when we talk about a recourse financing program, is big difference here. All patients are going to be approved regardless of credit, and that is on our program. So a patient would be approved for a $10,000 loan if they have a $10,000 bill. It's as simple as that. On the non-recourse side, you're only gonna, if you have a $10,000 bill, your patient must only be able to be qualified for $3,000 depending on their credit. And then provider must think about, okay, what am I going to do with that initial or that leftover money on the $7,000? And so the best use cases for recourse and non-recourse by procedure category, we look at it. Your non-elective for recourse, your electives, really just kind of eliminate the cosmetics here. And then on the non-recourse side, really we find that it's fitting well with the elective and cosmetics. So two big differentiators there when we kind of talk about it. I want to set the tone for the rest of this. We're going to talk more on the recourse side of our financing program. So the best approach here and what we're going to look at, hospitals have to offer support to their communities, and especially more so during an economically depressed time during COVID, but also as a long-term strategy. It's important to get hospitals out of the banking and managing multi-million-dollar loan portfolios. We see this across the country. Most patients want to be met where their best needs are, and allowing providers to focus on that clinical side is important. You want to be able to give your staff the confidence to offer a program that they feel good about. Ultimately, getting cash in the door and being able to offer to their neighbor a loan program that they don't have to credit score and fill out paperwork for, in this touchless environment, make it as seamless and easy for your patients as possible. In terms of the journey and the financial journey, offer something that has pre-service, something that you can use based on your estimation tools. Fund your balance sheets up front. Get that money in the door quickly. We know that the financial impact has not been very friendly on hospitals and providers today. So you want that cash in the door quickly to be able to bring those balances down to zero. Post-service, obviously. So at any point in that financial journey, be able to offer something that's seamless. And then lastly, I think when we talk about relationships here, allow your staff to work with early out partners, collection agencies, someone that you already are partnering with. Don't take that out for the middleman and be able to have your vendor or someone that you're partnering with offer this in full control. You want to make it a true partnership. And by making that outreach from your staff and your existing relationships is going to provide both benefits on both sides. So where and how is it offered? You want to give patients every reason to pay their bill with all the resources. So we kind of break it down: convenient, simple, and adaptable. Pretty simple, easy to understand, but when we talk about it, have it be paperless, a seamless offering that's touchless. Remove those barriers for patients that want to pay, but they need the ability to pay. Simple definition of credit. And then when we talk about patient and all these arrows that are going into the patient, and I talked about the journey, have it be offered digitally. Hannah talked previously about some of our digital strategies with HealthPay24. Co-brand your marketing to be able to have it talk about from a partner relationship. And then lastly, your access teams, give them every offering to be able to provide options to your patients. And then understanding terms. So how far do you want to offer the program? Do you want it to be a short term? Do you want it to be a little bit longer term? How long is that term? What is that going to cost you? Are there any hidden fees associated with this? So a program should complement really what a provider is doing in-house that follows the payment hierarchy, like Hannah was alluding to earlier in the presentation. Providers don't have all the resources to extend the financing today to patients, and they really shouldn't. The present value of money is much higher when you're getting that dollar in the door quicker upfront, and we'll dig more into the cost and measuring the value of that a little bit later on. So hang with me. Allow your staff to focus on their priorities, and what is that today for your staff? Might be working with your payers. One thing we know that we had to do is to get this online for your patients and staff. So something that you do is self-enroll. Allow your patients to be able to, or guarantors to be able to self-enroll. Take that burden off your customer service staff for having them have conversations with those patients that don't want to talk to them. I know I certainly sometimes don't, want to pick up the phone. Patients can have multiple channels for patients to enroll, and that payment really is a success there. Are you going to charge interest or no interest? We've seen variables today in that low interest rate environment. Some providers want to choose 0% just to complement what they're currently doing today. And no way is the right way. It just whatever is fitting your community, and but just know that there are options out there. And then from a system standpoint, choose a partner that is able to take all your disparate systems, because we know that we all have them, providers have them, and be able to send their family one statement, be able to add on additional family members or friends to that line of credit. Wow. I mean, how budget friendly, how convenient would that be? Okay, be aware of things to be aware of. We talked a little bit about recourse and non-recourse. Do you want to be credit scoring your hospital patients that come into the ER? Is that the community perception you want to have? So, where does it fit from a recourse standpoint? Is that the program you want to choose in the hospital setting? Also be aware of additional fees from a program or hidden fees, and understand all the true costs that a program that your organization is going to choose for you and your patients. Will you be charged NSF fees, origination fees, prepayment fees, non-funded account fees, early termination fees from your contract, at-risk fees, all these things that you need to consider when you're looking at a program. And then funding here, are you going to get funding upfront? And so when we talk about upfront here, are you waiting for the patient to pay that partner of yours and then get the funding, or are you getting that money regardless of payments that are coming in? And then lastly here, compliance, I think last, but definitely one of the more important as we talk about cybersecurity and all the hacks that we're seeing today. Make sure that the partner you're with is fully compliant. As a bank, we have to be compliant. We're regulated by the federal government. We have Reg B, Reg Z, TCPA, HIPAA compliant, SOC 2, Type 2. I mean, all of these that are so crucial. Does the partner have a compliance staff and a dedicated team to be able to answer all these questions? And what happens if a risk is at play, and how will they handle that? Okay, so measuring costs, the fun stuff. I'm a little bit of a nerd in terms of when it comes to the financing side of it. And I think when we talk to CFOs, this is one of the more crucial points. And what's the true cost? What is the value here? A lot of folks want to talk about from an ROI perspective. You can't. It's not an investment. You're not putting money here in an investment. This is not a building a sleep center or a cancer center. This is a present value. And so getting that money in the door, we're looking at it from measuring the cost of a weighted average cost of capital, servicing costs, the bad debt rate. So hang with me. We'll walk through this here hand in hand, but as simple as it can be, if a provider has $1 million of payment plans, Typically, this is what we've seen across the industry. They're going to be most of them are going to be going out to 36 months on average. So we know that they have a 12 or 24 month payment plan policy that never abides. Patients always have exceptions. And so your average terms are going to be 36 months. Your account size is $1,000. Your monthly servicing cost is $5. So we look at it from a collection standpoint, monthly collections is 27 grand. Your cost there are 5,000. So your net monthly collections is 22,000. Okay. Weighted average cost of capital, that's a return on an investment. When you're building a cancer center or a sleep center, typically we hear it's about 8% today. Net present value before bad debt, and bad debt 20% on average for providers is 726,000. So we're going to look at the net present value in terms of what you're going to be getting is 526 grand on the $1 million. So where is that really a cost efficient for you to be managing some of these payment plans in-house from a long-term perspective? I know that a lot of providers want to keep 3, 6, 9 months, 12 months in-house. That's okay. But when we look at the next slide here, at some point, providers are actually losing money. When you get grandma that's coming in and paying $10 every month by check, what does that cost, over a 10, 15 year period to you? Is that really truly what the business that you want to be in? So maximizing the value of payment plans and some of the drawbacks that we're going to kind of highlight here, they're expensive to administer, they're higher defaults, and it's a poor use of capital. And we talked to providers today and what they're doing internally. We're really here to complement what providers are already doing. Not to say that they're not doing it well. It's just saying we're going to come in and we're going to be that longer term option for your patients. It's a necessity. And we know that when providers are offering internal payment plans, from a long-term perspective, they're very expensive to administer. I just showed you some of that and what that net present value looks like. You must really think about what that expense is. And is it when you take the credit card, there's a cost to that right off the top, interchange 2 to 3%, statementing, late notices, lockbox costs, patient bounce checks, phone calls. All of these, do you want your staff to be doing this on an ongoing basis long-term? When you add all that up, it's expensive on a multi-million-dollar portfolio. So healthcare providers, we all know they're really, really, really good at providing care. Plow that money back into that hospital. Build sleep centers, surgery centers, telehealth, all the great things that we're reading and seeing providers do today. That's where providers will get that most bang for their dollar. It's not building portfolios of bank loans. We sometimes hear some providers have more in their payment plans than some of their smallest local banks down the street do in deposits. That's scary. But hospitals weren't meant to be in that business, and they certainly don't want to be. They're pushed that way by the rise of the deductibles and the way that patients are paying today in that payer mix, like we discussed. So on the right-hand side, the keys to the successful payment financing program, and it really comes down to these simple tasks here. Gross funding that provider 100% upfront and right away. Bring those accounts down to zero. And we bifurcate it. We want the billing system to be zero, the general ledger to handle all those fees associated with it. Don't net the two. It's really confusing from a reconciliation standpoint. Get that money in the door for $1,000 balance at $1,000. Our program has one fee. It's a percentage of the loan. And some programs will have multiple fees associated with it, from non-funded accounts, like I talked about, at-risk fees. Ours is a single fee to the provider. It makes this as simple as possible. And if you do it the right way, use a patient financing company that you see on average the value of what providers are doing, like I did in the previous slide, over 48%. That's a significant amount. Lastly, partner with a bank that provides you the lowest cost in the market. And by allowing a bank to do that, we're passing the savings on you to the provider, because we're utilizing our own deposits. We don't have to go to a middleman to get that money to create that loan. So lastly, I want to kind of end in these last two slides here, and just something to consider or take away. What is that true cost of the time and resources to service these payment plans? Is there a more effective way to optimize the value and limit the risk while treating your patients fairly and without discrimination? Offering your patients something that is not giving someone one deal and someone another deal. Make it structured but flexible. Is there a point at which your organization would lose its mission focus due to the obligations of servicing a multi-million-dollar loan portfolio? Okay, so in closing, the benefits to a successful approach. So I know everyone's writing these down, but if you give patients a line of credit that they can use for care, they will come back to your facility. We see that time and time again. Patients want to go to places where they have options. Now that they have the access and affordability, maintain that control. Providers that are using, providers in their existing early out companies should offer these programs and make it as seamless as possible. Don't lose control of programs by allowing someone to offer these loans to your patients, reducing overall expenses and streamlining that enrollment. So with that, I know we have a little bit of time left on the clock here. We want to give it for questions. If anyone has any, I don't know if I haven't been checking the chat box here, but we'll allow anyone for any final questions.
Like we had a question in our chat. Within healthcare, patients are coming in continuously and will continue to build their bills to a facility. Are your payment options like a line of credit where your new bills will be added automatically to their payment options, or do they need to open a new line each time and have multiple payments needed?
Yeah, that sounds like great question. So yes, the answer is your patients can continue just to add on to that one line of credit, and they can even add on family members to that line of credit to make it like I mentioned before, a family budget option. They can add friends to that if they needed, someone that they're trying to help out. We don't care as long as that patient has all the correct demographics that you're sending us in a file to make it as automated as possible.
And that also, just to add to that, that extends to also short-term payment plans in the solution that we offer here at Commerce Bank. You can add to short-term payment plans in the same.
Is that it, Hannah?
We've got says, what are the costs to the provider? I'm not sure if that's in terms of.
Yeah, so Hannah's talking a little bit about digital strategy and what we're doing there, but ultimately, it could range, right? Are you choosing to offer an interest program, where if you are, we can essentially have the cost be zero for you as a provider. Interest rates are so low right now where the cost to administer these loans and from the patient side, they're not paying much in interest. Now, if you are charging a 0% loan, it's typically just a fee based on how long you want to go out to. Looks like there's another one there, Hannah.
Yep, I see that here. So what's your implementation time frame in this virtual environment? You probably have two answers to that as well.
Yeah, go ahead, Hannah. I'll let you take this one.
I would say with implementing a digital strategy, so adding things like text to pay, short-term payment plans, prompt pay discounts, all at the fingertips of the patient. Typically, it's about a 6-week implementation. It can be shorter, can be longer, depending on how much customization is built around the system, but about average is 6 weeks.
Yeah, right now we've adapted to this from our agile approach that we do here at Commerce, and we've become pretty efficient with it. And so implementation, we just implemented a major health system, multi-billion-dollar health system out in Michigan in less than 6 weeks. So streamlining the approach and implementation, I think is what we pride ourselves in. And so we've allowed this environment to become better and more efficient at that.
All right, we got another one for you, Taylor. Is the provider taking out a loan as well?
Well, we underwriting in terms of, we're not underwriting your patients, so we just look at the strength of the hospital system. So it's an unsecured loan because we're providing you your patients the affordability to maintain these payment plans. So it's not necessarily a loan per se, but the strength of that provider is going to be looked at from a credit perspective.
Got a lot of questions. I like this. References or referrals on request?
Yeah, absolutely. I know everyone wants to talk to folks that are similar to them. Commerce is more than willing to offer that. We do also open chats with some of our providers to feel free to join at any point in time. Reach out to myself, Hannah, or Kate. Always happy to make introductions and folks that you're familiar with from an EMR perspective or looking from an online digital platform.
And speaking of that, Taylor, I believe, and correct me if I'm wrong, there's a recorded one that we recently did with one of the health systems that we partner with that's available on our LinkedIn. If folks want to see a presentation that a provider's done with us in the last month or so.
Yeah, great point there, Kate. Thank you.
Ready for some more? We have another question that says, would it be up to the provider to update a patient account, or would it be the responsibility of the patients? I imagine that's probably in amounts due or bills, medical bills.
If the patient has an additional service, it's as simple as talking to the staff at the hospital, the early out partner, make an inquiry through our the self-enrollment site. So there's multiple ways the patient can add on by doing that self-servicing. Try to make it as seamless as possible so they don't have to have any friction there.
Part of the integration I mentioned earlier includes of just automatic updates to a patient account. So, a patient signing in to make an online bill, they would see almost in real time, essentially any new amounts that are owed, and they can add those to their payment plans or pay on the spot. All right, I'm bouncing between question and answer in the chat. So what is a good loan adoption rate providers should strive for?
Yeah, it varies between demographics, obviously, and how well the staff is trained to offer a loan program. Is it an easy way for the staff to enroll the patient? So with all these little variables, it can vary. You want to look at it from a percentage of your net patient revenue. But really, it all just comes down to, really on the staff side, how adopted are they into offering a loan program? Typically we'll see about in the 2 to 3% of your net patient revenue, but again, it all varies in how successful they are at offering the program, and ultimately the patients, satisfied.
All right, another one for you, Taylor. Who becomes responsible if the patient doesn't pay?
So the Recourse program, I think what this person is referring to is the loan will go back to the provider to further process, typically send it to bad debt. However, that waterfall or workflow is going to work. Commerce here, just a plug, will return the fee 100% no matter what, at any point in time, no matter if it's a guarantee. So there's absolutely zero risk to provider to enroll a patient because you're going to get your fee back if that comes back to you. Most of the time, if they never paid us, they probably weren't going to pay you, so they had never any intention to pay. I'm sure a lot of providers out there are shaking their heads, haven't seen that one before. But at least you're giving that patient an option and awareness to want to pay a bank.
I see one more question here, at least for now. What was the auto ad again?
Oh yeah. Okay. So the auto ad is, say I go to the facility and I sign up for a line of credit with Commerce, and I keep, I'm a frequent visitor of the hospital. Maybe my family is. We have, multiple kids, and I say, I love that program. Can you just add all my additional service to that? Yeah, absolutely. We can. The patient has to agree to it. Some hospitals want to do this, some don't, because they may want to collect some of the co-pays up front and get some of those cream of the crop. So really it just depends on the engagement and how the provider wants to offer that. But we try to make it from an automated standpoint as much of to remove some of the manual work for patients and the staff that ultimately want to just enroll in this program again and again. We allow that to happen.
How does Commerce's program compare to a company like Care Credit?
Yeah, great question. Again, I think we strive ourselves in being a low cost provider. And so because we were able to use our own deposits, our own money, it's all in-house. We service everything on our non-recourse program. We are lower in terms of cost to your patients for a Care Credit program. I don't know all the ins and outs of the Care Credit side, so I can't speak to it, but just right off the top, from a seamless and a financing cost perspective, we tend to at least see ourselves on the lower end of that spectrum.
See any new questions at this point?
Okay. Thank you.
Well, thank you, Taylor, Kate, and Hannah. We really appreciate you sharing your time and all your expertise with us today. Very, very grateful to you. As a reminder to everyone who is still here on the webinar, I will provide the presentation to you in a post-webinar email that you'll receive from me. So you'll have that information, and in that presentation is the contact information for all of our presenters today. I'm sure if you have any additional questions, they would be happy to ask them. And actually one just popped up. Ooh, right before the buzzer. What is the average interest rate for patients?
Yeah, on our recourse program, Commerce offers a prime -2 prime program, a prime +1, prime +2, and a prime +4 program. So prime being, Kate, correct me if I'm wrong, it's 3 1/4.
Oh gosh, you're putting me on the
So
spot.
yeah, put you on the spot there. 3 1/4, relatively
today.
from an interest program. A lot of providers want to put that onus back on the patients, and Commerce does offer a number of those programs. So yeah.
But Taylor, there are a number of, correct me if I'm wrong, but there are a number of health systems that offer it at a 0% interest rate as well, to mirror what they do internally to increase adoption of those longer term payment plans.
Absolutely. And from a 0%, you're obviously going to get more patients to enroll. And who want to take a 0% loan over an interest rate any day? I think any financial advisor would tell you to do that time and time again. So, but it just depends on a lot of different providers want to choose different programs, and we do that. Most of our providers are on our 0% program, but it doesn't make it right or wrong to offer anything out there in the market, especially in this lower rate interest environment.
Thank you so much. And it looks like we have one final question to me.
For you.
Asking about certificates of participation. And yes, I will send out certificates of participation. Just give me a couple days to get those all together, and I will send those out to everyone who participated today. So with that, that concludes our webinar today. So thank you all again for spending your lunch hour with us, and thank you very much to Commerce.
Thank you.
Thanks, everybody.
Have a great day, everyone.